What up, HyperChange? Rivian just reported earnings, got a lot of interesting information here. You know I love to follow the electric vehicle revolution, so let's take a look at what Rivian reported here. The biggest news that I thought was interesting is they're on track for a positive gross profit in the fourth quarter of 2024. They have been guiding for that for the whole year now. Everyone thought they wouldn't be able to hit it, but they are still guiding for it despite it looking very hard. So that is a very impressive thing. But Rivian is in this very interesting equation now where they're taking on money from Volkswagen. Growth is stalled. They're betting everything on this R2 vehicle, which they say the big number here is they're approximately 85% through the sourcing of R2 bill of materials in line with our cost targets. That sounds like a lot of jargon to me, not inspiring much confidence that a big launch is around the corner, but they are saying they're making progress on the R2, which is obviously the make or break of the company. I think if they can show an improvement in gross margins, then that will be an absolutely massive deal for them. So now let's look at what the gross margins have been and why that's such a big leap. They reported negative 45% gross margins in the quarter. That was worse than negative 30% in Q2, negative 39%, and worse than the 36% in Q3 of last year. So the gross margins were actually worse than ever. They're claiming they're going to go from negative 45% to positive next quarter, which is crazy to me, but is also possible. So if they could pull that off, I think that would be very, very bullish. They would have managed to cut R&D costs significantly to $350 million, down from $428 million last quarter. SG&A has been cut year over year and quarter over quarter. So their operating expenses total were only $777 million, down from $963 million in Q3 last year. So they're trimming down and leaning down, which is great. And now their operating income, they only lost $1.2 billion instead of $1.4 billion. But yeah, that's way too much money to lose. So that's the problem with Rivian is they keep burning over $1 billion a quarter with no end to that in sight, unless they really do turn things around next quarter. But I just feel like that's a moonshot. And their cash, $5.4 billion plus $1.3 billion, about $6.7 billion in cash, continues to dwindle. And now they're selling more and more stock at lower prices. So the biggest thing that I would highlight for Rivian investor is, and this is the number one thing I'm watching, is Rivian is being forced to dilute their equity here at a much lower price than they want. When they sold shares to the public, they sold them at $100 the day it opened, and that's what investors bought in at. Now they're selling shares at $9, $10 a share to Volkswagen, and that's 1 billion shares or $1 billion of capital that they burn a quarter that they have to dilute is 100 million shares at $10 a share. So as you can see, their share count now continues to rise at an even more accelerated rate. So their share count at the end of Q3 was 1.014 billion shares, up from 952 million. So that's about a 6.5% increase. So Rivian's share count right now is increasing about 6.5 or 7% per year. And it's this weird self-fulfilling prophecy, because if the stock doesn't go up and start bouncing up, then they're going to have to keep selling more and more stock at these low prices, and their share count will start to balloon. And that's where you kind of get screwed as a shareholder, because Rivian keeps selling more and more stock and your piece of the pie that you own keeps going down. So this is the number one thing I'm watching, is now that Rivian stock is staying here and they continue to burn cash, they continue to have to dilute shareholders, and this share count number goes up. And so that's making all the valuation math very hard. So if we look at the cash flows for the 9 months of this year, $4 billion loss from operating activities. Not some of those non-cash expenses though. So their cash burn from operating activities actually decreased as their production has decreased. So Rivian is, long story short, they're burning less cash, but $6.7 billion in cash, burning $1.1 billion a quarter. They have 6-ish quarters left of cash. That's only going to get them until, just the early of 2026. So they need to count on more billions coming in from Volkswagen. Those are going to be more dilutive. And they can't afford really any more delays or part issues, which they were having, because they're walking this fine line. So I don't own any Rivian stock. I don't think I will for a while. But I do think we need them to succeed for the electric. It's just great to have more electric vehicle companies. And it could hurt them big time if the tax credit goes away. So that's something in the near term that could hurt them. But the flip side is I'm just watching this fascinating game of Rivian try and get to profitability, raise enough money, and kind of keep the lights on to try and launch the R2, which I do think has massive potential, but they got to survive until they launch it. So let me know what you think in the comments below. This is HyperChange. See y'all next time.